Have you ever wondered how some companies don't just, survive economic shifts, but actually manage to harness them? Use them as, like, springboards for explosive growth.
It's fascinating, isn't it?
Yeah. Today, we're pulling back the curtain on the strategic playbook of a real manufacturing powerhouse. Welcome back to The Deep Dive, your shortcut to being well-informed without getting completely bogged down.
That's right. And our mission today is to take a deep dive into Dixon Technologies, India Ltd. We're drawing insights from their recent Q1 FY2025-26 earnings call.
Okay.
So we're going to unpack their frankly impressive financial performance, explore how they're fueling growth across all these different segments.
Yeah, the diversification is key.
Exactly. And peek into their ambitious future outlook and also, crucially, understand the strategic risks they're navigating.
So this deep dive should really give you, our listener, a crystal clear sense of their industry outlook and, well, exactly where they're headed.
Right. Positioning themselves not just for today, but, thinking longer term, decades, potentially.
Okay, let's unpack this then. Because the headline numbers for Dixon's Q1 FY26, they're just phenomenal, truly eye-popping.
They really are.
We're talking about massive year-on-year growth that genuinely sets them apart. So imagine this. Consolidated revenues practically doubled, soared by a staggering 95% to 12,838 crores. Now, for our international listeners, a crore is 10 million Indian rupees. So that's roughly, what, 1.5 billion US dollars in revenue?
Yeah.
Just for the
Safety
quarter.
Q1? Yeah.
And their consolidated EBITDA, that's basically their core operational profit, it rocketed up an incredible 89% to 484 crores. And the consolidated profit after tax, the PAT, leaped by a full 100%, doubled to 280 crores.
It's just the scale of the jump is remarkable.
These aren't just good numbers. It feels like a company absolutely firing on all cylinders.
And what's really fascinating here isn't just the sheer scale of that growth, that's obviously impressive. It's the underlying financial discipline that supports it.
Ah, okay, so it's not just top-line growth.
Exactly. It's not just a surge in sales. It's built on a rock-solid foundation. For instance, their working capital cycle stood at -4 days.
-4, that's wow.
It's exceptionally rare and powerful. It basically means they're collecting cash from customers before they even have to pay their suppliers.
So customers are almost funding their growth.
In effect, yes. It gives them significant internal funding, a powerful cash flow advantage. They also boast an incredibly strong balance sheet net debt of -14 crores.
So more cash than debt.
And their return on capital employed, RCE, was a very healthy 33.9% as of June 2025.
Okay.
So these metrics, they aren't just numbers on a page. They reflect a really robust business model, and they guide those strategic investment decisions for long-term value. Shows a clear, disciplined vision.
Those are stellar numbers. But, in a period of such rapid growth, the market often asks, is this just a cyclical surge, or is Dixon's underlying strategy truly driving sustainable long-term growth?
Yeah.
How much is structural versus just, opportunistic right now?
That's a critical question, absolutely. And what these numbers truly reveal, I think, is Dixon's strategic pivot. They're moving from being just a contract manufacturer to becoming more of a vertically integrated electronics ecosystem builder. It feels like a very deliberate strategy.
Okay, ecosystem builder. Explain that a bit.
Well, their confidence seems to stem from a mix of things. A diversified portfolio, these deeply entrenched customer relationships they've built, and a relentless focus on operational excellence. They're not just assembling products anymore. They're making significant strategic investments to expand manufacturing capabilities and, crucially, deepen their component ecosystem.
So making more of the parts inside the products.
Exactly. This is about resilience. It's about locking in value further up the chain. They're essentially building a truly future-ready business, one that can potentially thrive even as market dynamics shift, like the PLI changes coming up.
Okay, the big picture is certainly compelling. But where is Dixon really seeing the most granular growth? Let's dive into each segment, because that's where we see the future taking shape, right? And how the industry outlook might be changing.
Absolutely. Each segment tells a story of strategic positioning and, frankly, aggressive expansion. And collectively, they paint this picture of a company aiming to dominate multiple verticals.
Let's start where the action seems hottest. Mobile phones. This segment is undeniably, driving the bus for Dixon.
It really is the powerhouse right now.
In Q1, it raked in an astounding 11,663 crores in revenue. That's a massive 125% year-on-year growth.
Just staggering growth.
And operating profit up an equally impressive 131% to 395 crores. Volume-wise, they produced 9.6 million smartphones and 5.73 million feature phones, just in Q1. And the outlook for Q2 looks even stronger. They're expecting, what, a 15% quarter-on-quarter volume growth for smartphones? Yeah, pushing volumes to around 11.4 million. It's incredible scale.
And if you connect this to the bigger picture, their already strong position as the largest domestic mobile phone manufacturer is about to be supercharged.
That's so.
Well, their new 8 million square feet campus in Noida, it's expected by March 2026. That just signals a massive scale up.
8 million square feet. Okay.
It's about securing market leadership through sheer capacity and efficiency. But I think the real game changers here are the strategic joint ventures, the JVs.
Ah, yes, the JVs. Let's get into those.
They're not just solidifying their market position, they feel very strategic in terms of future-proofing the business.
And these JVs are really diverse, aren't they? They give incredible insight into the strategy. First, there's the Longcheer. JV Dixon holds 74%. And for our listeners, Longcheer is one of the largest global ODMs, original design manufacturers.
Right, so not just building to spec, but designing too.
Exactly. Gives Dixon a greater, say, potentially a larger slice of the margin. This JV doesn't just firm up relationships, it expands their portfolio beyond smartphones.
Yeah.
They mentioned a joint design center too.
Yeah, and they expect to capture basically all of Longcheer's Indian volumes, which is estimated at around 25 million units. Huge!
Wow, okay, then there's the Vivo JV. Dixon holds 51%.
And Vivo holds, what, about 22% of the Indian mobile market?
Yeah, something like that, which translates to a massive 35 million units annually.
So the JV is set to handle 2/3 of that.
That's the plan. 2/3 of Vivo's production for India, meaning 20 million units flowing through this partnership.
It clearly demonstrates their strategy, right? Deeply integrating with major established brands, becoming indispensable partners.
And then the QC India JV. This one feels transformative. 51% stake in camera and fingerprint modules.
Yes, Queek, their partner, is a top 5 global camera module manufacturer, supplies all the major Android brands.
And think about this. Each mobile phone needs, what, on average around 3.2 camera modules?
Something like that, yeah.
So the Indian market alone consumes a staggering 475 million modules annually.
It's a massive number.
And Dixon's own in-house consumption from this JV will reach 190 million modules in the next 2 years.
Right, feeding their own assembly lines.
They're targeting an ambitious 5,000 crores in revenue from this JV over 4 or 5 years. That's a huge jump from just under 2,000 crores last year.
And the investment. Around 400 crores for the stake, plus another 150 crores for capacity expansion. It's serious money.
This is about deeply integrating into the supply chain, isn't it? Capturing more value.
Exactly. And this specific JV is where we see a significant play for margin expansion.
Ah, right.
Yeah.
Because component manufacturing usually has better margins than just assembly.
Precisely. Their current EBITDA margins from mobile manufacturing are, say, in the 6.57% range. But with the QC India JV, they're aiming for 8.5, 9.5%.
Okay, wow.
Driven by PLI benefits, that's India's production-linked incentive scheme, giving cash incentives for local manufacturing.
Which directly boosts profitability.
Right. Plus further deepening of their manufacturing processes, and then just the operating leverage you get from increased volumes. It's a strategic move to capture more value internally.
Makes sense. And there's another crucial JV with HKC. That's for display modules, right? A 7426 partnership.
Yes, construction is underway. Trials expected in Q4 this fiscal, mass production by Q1 next year.
And the capacity.
It's significant. 2 million mobile displays per month, expandable to 4 million, plus 1.8 million notebook displays.
And I saw something about flexibility there.
Yeah, this is key. These production lines will be fungible for automotive displays. They're targeting 2.5 million units there. Expected CapEx over time is around $130 million.
That flexibility is a hallmark of their forward-thinking strategy, being able to pivot between consumer, IT, and auto.
It definitely reduces risk, but it also raises that important question, the one that's top of mind for many investors. What about the PLI scheme? It's set to end in FY26.
Right, the incentive scheme that's been boosting margins. What happens when that goes away? That's a major risk factor.
It is. But the company's strategy, especially with these JVs and this deep backward integration into components, feels like a clear response.
So they're building inherent competitiveness beyond the incentives.
That seems to be the plan. They're relying on their massive scale, the strategic JVs, and this deeper integration into camera and display modules to provide a competitive edge even after PLI benefits sunset.
And they actually anticipate margins expanding.
Believe it or not, yes. By 150 basis points in FY26-27, even without PLI, and potentially even higher in FY27-28 as these component projects fully ramp up.
So they're proactively addressing a key industry risk, shows confidence in their own capability.
It does, it's quite bold.
And it's not just about the domestic market either. Dixon is looking outward. We shouldn't forget exports.
Absolutely not. They're projected to jump from 1,600 crores last year to an impressive 7,000 crores this year.
Wow, that's more than a four-fold increase.
And they're aiming for 11,000 crores as they pursue a large new opportunity. While average selling prices are apparently similar to domestic, they expect margins to normalize over time.
Still, that showcases their global ambitions. It's a powerful signal of India's growing role in global electronic supply chains, isn't it?
Definitely. Okay, so beyond the undeniable surge in mobiles, Dixon's also making strategic moves in our homes. Let's pivot to consumer electronics.
Right. TVs and fridges. What's the story there?
Segment revenue was 672 crores in Q1. Now, they mentioned TVs had a bit of a miss in Q1,
Okay.
but refrigerators performed exceedingly well. And the outlook for Q2 is strong for the whole CE segment, expected back to around 800,000 units total, so a rebound expected.
And for LED TVs specifically, what's the focus?
It's increasingly on ODM, Original Design Manufacturer Solutions. These now account for 72% of sales.
So brands are coming to them for the whole package, design and manufacturing.
Exactly. Strong interest from new brands. And they're not just increasing capacity, they're actively working on industrial, institutional, and even automotive displays, broadening horizons beyond just the living room TV.
Diversification again.
Yeah.
And refrigerators. You said they did well.
Incredibly well. They captured 10% of the Indian direct cool market within just a year. That's rapid market share gain.
10% in a year. That's fast.
It is. Capacity is expanding rapidly, too, from 1.2 million to 2 million units in their existing facility, and they're diversifying within cooling side-by-side refrigerators, mini bars, heaters, coolers.
So new product categories.
Right. They're projecting 50% growth this fiscal year alone, with meaningful contributions expected in the next couple of years. It's smart diversification into high-demand categories.
Okay, shifting gears slightly to home appliances, washing machines, etc. That segment saw revenues of 313 crores in Q1, with a healthy 13% year-on-year growth.
And capacity expansion there will be ready by August 2025. They've strategically launched high-capacity semi-automatic washing machines, 16 and 18-kilogram models.
Catering to larger family sizes, maybe?
Potentially, yeah, addressing a specific market need. They've also partnered with Eureka for robot cleaners, tapping into that smart home trend.
A robot cleaner, okay.
And importantly, they've hired a senior Korean expert to drive their front-load washing machine project. That's a higher value segment.
Ah, bringing in specific expertise.
Exactly. They expect this whole home appliances business to grow from the current 1,200 crores to maybe 1,800, 2,000 crores in a couple of years. Again, clear signals of pushing for product diversification and higher value.
Right. What about lighting? That segment recorded 188 crores in Q1 revenue. It's traditionally been a strong area for them, hasn't it?
It has, but what's really exciting here is the new 50/50 JV with Signify.
Signify.
Yeah,
They make Philips brand lighting, right?
correct. That JV starts in August 2025. And this isn't just another partnership. It strategically shifts their manufacturing towards more premium products.
Okay, moving up market.
Yes. It expands their portfolio with hundreds of new lighting solutions, leveraging combined R&D, and crucially, provides direct access to global markets.
Global access, interesting.
They've even secured a pilot export order already from a major U.S. retail chain for strip and rope lighting. The plan is to scale that up dramatically.
So doubling revenue again.
That's the goal. From around 850, 900 crores currently to 2,000 crores. It's a major leap in their industry outlook for lighting, moving into global premium territory.
Okay, that's quite a jump. Now, telecom and networking products, this segment saw truly explosive growth, up more than 250% to 1,410 crores.
It's a staggering jump, isn't it? This incredible surge is fueled mainly by the rapid government penetration of 5G, FWA.
FWA, fixed wireless access.
Exactly. Basically, wireless internet for homes and businesses, a big push in India right now. They also have a strong order book for IP set-top boxes from anchor customers.
And are they integrating components here too?
They are deepening backward integration by localizing things like moldings and adapters. And they're in advanced talks for a JV for critical telecom components.
This is the same strategy playing out here.
Very much so. They view this as a multi-year growth opportunity, targeting, get this, 5,000 crores revenue in a year or so.
5,000 crores from 1,410 crores now.
That's the target. It's a direct play on India's digital transformation. Massive potential.
Okay, IT hardware, laptops, tablets, etc. This feels like a new frontier for them, but one with huge potential globally.
Absolutely. Their Chennai unit has already started mass production of laptops and all-in-ones, AIOs for HP and other big groups. Volumes are apparently picking up month by month.
And the ambitions here are big too, I assume.
Huge. There's a 60/40 JV with Inventec. They're one of the top 5 global PC ODMs.
Inventec, okay.
That JV will start operations by Q1 next fiscal, making notebooks, AIOs, servers, desktops, and Inventec will help with backward integration too.
Meaning Dixon can make more of the internal parts themselves eventually.
That's the idea. They're also exploring SSDs and memory modules. They see this as a long-term play, expecting revenues of maybe 3,000 crores in a couple of years.
3,000 crores. And there was another JV mentioned for components here.
Yes, a binding term sheet for a 7426 JV with Chungsin UI for precision mechanical and metal parts.
Like the casings and internal structures.
Exactly. Initially for existing customers and notebooks, but potentially extendable to smartphones later. That's about 100 crore investment.
And the margins in IT hardware. Expected to be very robust, according to them. Double digits. Which highlights that strategic move into higher margin areas, moving beyond just basic assembly.
Right. Finally, let's quickly touch on wearables. Smartwatches, fitness trackers.
Yeah, that segment contributed 175 crores in Q1, apparently with healthy margins.
Okay.
They have a strong order book, and they've rapidly expanded their portfolio. Now includes dash cams and smartwatches, tapping into that whole connected devices market.
Daft cans too, interesting.
And they're setting up a new manufacturing location in Chennai, specifically for wearables to meet increased demand, expected to be operational by Q4 this fiscal.
So continuous portfolio diversification, agility to meet consumer needs.
That's the theme across the board, really.
Okay, this kind of aggressive growth, this expansion across so many diverse segments, it clearly requires significant capital investment. And, maybe even more importantly, the right talent and operational readiness to actually execute it all at once.
Yeah, it's like running several demanding startups under one big corporate umbrella.
Exactly. So what's the CapEx strategy? It's aggressive, but seems carefully planned. In Q1, they spent 287 crores on capital expenditure. For the full fiscal year, FY26, they're anticipating a total CapEx of around 1,150 to 1,200 crores.
Okay, over $1 billion roughly. Where's that going?
It's a mix. Expanding existing capacities, but also funding strategic acquisitions and these new JVs. Remember, a massive chunk, 750, 800 crores alone, is earmarked just for the camera and display module JVs.
Reinforcing that vertical integration theme we keep coming back to.
Precisely.
But that raises a critical point about managing this kind of explosive growth.
Yeah.
You simply can't scale like this without the right people, the human capital. How are they tackling that challenge? Attracting and integrating top talent across so many new and expanding ventures.
They seem very aware of this. They're actively acquiring talent, recognizing it's absolutely foundational to their growth plans.
Any specifics?
Yeah, they mentioned recently hiring a VP for strategy and digital transformation, a VP for their new components business, a Taiwanese expert to head up display manufacturing.
Bringing in international expertise.
Exactly. Also, a Korean expert for washing machine R&D, and a VP for HR to make sure the organizational structure can actually handle this scale.
So building the management bandwidth.
Right. They acknowledge it's an ongoing process, but they feel they're in a sweet spot for attracting talent, given their market position and, well, their ambitious trajectory.
That proactive approach to talent management seems like a critical part of their operational readiness.
Yeah.
And risk mitigation too, I suppose.
Definitely. You can have the best plans, but you need the people to execute.
And speaking of potential hurdles or risks, many of these JVs, particularly the ones with Chinese partners like Longcheer, HKC, Vivo, Chungsin UI, they require government approvals, right? Specifically under India's PNP scheme.
Yes, that's correct. PNP, Production Notified Product Scheme, it governs specific manufacturing activities, requires approvals.
So how are they navigating that potential bottleneck? It could cause delays.
It's a significant regulatory aspect for sure,
Uh-huh.
and they seem to be addressing it head on. While these approvals are apparently under evaluation by the government, the company states that the project installation and implementation, building the factories, setting up lines, is carrying on in parallel. It's not hinging, as they put it, on getting those approvals first.
So they're building concurrently while waiting. That's a proactive approach to managing potential delays, taking a calculated risk, perhaps.
Seems like it. Mitigating the risk by continuing the operational build-out. It's worth noting, too, that the QC India unit, the Camera Module 1, was set up before the PMP rules were modified, so it doesn't actually need this specific approval.
Okay, that helps. But it shows a clear strategy to manage these external risks and try to keep their expansion timelines on track as much as possible.
Exactly.
Wow, what an incredible deep dive. This is a company that's not just growing at an astonishing rate, but genuinely seems to be strategically reshaping its entire future.
It really feels that way.
We've seen how Dixon Technologies is leveraging truly impressive financial performance, driving aggressive segment expansion through these really insightful JVs and that deep backward integration.
The vertical play.
And it's all underpinned by what seems like a clear vision for navigating future challenges. Things like the PLI sunset, the complexities of government approvals for JVs.
Yeah, this comprehensive strategy really positions them, I think, not just as a contract manufacturer anymore, but as a key player deeply integrated into the entire electronics ecosystem.
Poised to capitalize on India's burgeoning manufacturing landscape, and maybe that global shift in supply chains we hear so much about.
It certainly reflects a very strong future outlook for the industry itself, with Dixon positioning itself right at the forefront.
So for you, our listener, this story presents just a fascinating case study in strategic growth, especially within a dynamic economy. It really makes you wonder, doesn't it? In this rapidly evolving global manufacturing landscape, what does this kind of multi-sector deep integration strategy really mean for the future of businesses, particularly in emerging economies like India?
Yeah, and how will companies balance that kind of rapid expansion with maintaining quality, maintaining agility, and finding that critical talent pool needed to sustain it all?
That's the balancing act, isn't it?
And maybe, how will these aggressive, localized investments, like the ones Dixon's making, ultimately drive further fundamental shifts in the global supply chain? Could we be seeing the start of a new era of more decentralized manufacturing?
Lots to think about there. Keep pondering, keep learning, and we'll be back with another deep dive soon.